Welcome back to the Simple Retirement channel, where we make retirement simple. Today we'll be exploring a concept called velocity banking. Now I know that may sound like a term straight out of a physics textbook, but bear with me. It's a financial strategy that could potentially turn the wheels of your debt management in a favorable direction. Velocity banking, in its essence, is an alternative method of debt elimination. It's not your run-of-the-mill pay more than the minimum due advice. It's a tad bit more strategic than that. It's about using a line of credit to pay off debt faster than traditional methods. Let's break that down a little. You see, when it comes to debt, time is money, literally. The longer you take to pay off your debts, the more you end up paying in interest. Traditional methods focus on paying off the smallest debts first, or targeting the debts with the highest interest rates. While these methods are effective, they may not always be the fastest way to wipe out your debt. This is where velocity banking comes into play. The strategy uses a line of credit, such as a home equity line of credit or a P-lock, to pay down debt in large chunks. The goal is to reduce the amount of interest you pay over time, thus accelerating the rate at which you eliminate your debts. But any financial strategy, velocity banking isn't a one-size-fits-all solution. It's a tool, and like any tool, it works best when used correctly. It requires a good understanding of your financial situation, discipline, and of course, a solid plan. The concept may sound complex at first, but stick around as we break it down for you. In the upcoming scenes, we'll delve into the nitty-gritty of velocity banking, explore its pros and cons, and help you determine whether it's the right strategy for you. Before we dive deeper into velocity banking, it's essential to understand two key components of this strategy: the home equity line of credit, often referred to as a HELOC, and the personal line of credit, or P-lock for short. Start with the HELOC. Picture your home as a piggy bank. Over the years, as you've paid your mortgage, you've been filling this piggy bank. The equity you've built up in your home, the difference between your home's market value and what you still owe on your mortgage, is your savings. A HELOC allows you to tap into this equity. It's a form of revolving credit with a set limit, much like a credit card, but with typically lower interest rates because your home serves as collateral. On to the P-lock. This is similar to a HELOC, but it's not tied to your home or any other asset. It's based purely on your creditworthiness. Again, it's a form of revolving credit, but the limit might be lower than a HELOC. And the interest rates might be higher because the lender is taking on more risk. So how do these fit into velocity banking? Let's say you have a mortgage, a student loan, and a car loan. Instead of paying these off separately, you could use a HELOC or P-lock to pay off these debts. Then you focus on paying off the HELOC or P-lock. The idea is that the lower interest rate of the HELOC or P-lock compared to your other loans could save you money over the long term. Moreover, these lines of credit can also serve as a safety net. If an unexpected expense crops up, you can tap into your HELOC or P-lock instead of resorting to high-interest credit cards or personal loans. These credit lines are the pillars of velocity banking, allowing you to pay down debt faster while maintaining a safety net. Remember, every financial strategy comes with risks, and it's crucial to weigh them against the potential benefits. In our next scene, we'll dive into the mechanics of how velocity banking works. Stay tuned. Now that we've covered HELOC and P-lock, let's delve into how velocity banking works. Imagine you're a runner on a track. The goal is to complete the race in the shortest time possible. This is essentially the principle behind velocity banking. It's about paying off your debt as quickly as possible, thus saving you from the burden of interest that accrues over time. Picture your debt as the track, and your line of credit as your running shoes. The shoes don't eliminate the track, but they enable you to run faster, reducing the time it takes to complete the race. In velocity banking, you use your line of credit to pay off a significant portion of your debt, thereby shortening the track. So how does it work exactly? Well, let's say you have a mortgage or other large debt. You would take a chunk of this debt, say a quarter or a third, and pay it off using your line of credit. This reduces the principal amount of your debt and consequently the interest that accrues over time. Now, instead of making small monthly payments towards your debt, you focus all your disposable income on your line of credit. You're essentially shifting your debt from the mortgage to the line of credit. The key here is to pay off this line of credit as quickly as possible. Once you have cleared the line of credit, you repeat the process. You take another chunk of your debt and pay it off using your line of credit, then focus all your disposable income on clearing the line of credit. This cycle continues until your debt is cleared completely. Remember, the goal here isn't just to clear your debt, but to reduce the total amount of interest you pay over time. By paying off large portions of your debt at once, you're reducing the principal amount, and consequently, the interest. Banking is a repetitive cycle aimed at minimizing the amount of interest paid over time. And just like a runner on a track, with each stride you take, you're getting closer to the finish line. The script section provided does not contain the term "block," hence no replacement can be made. However, like any financial strategy, velocity banking is not without its risks and drawbacks. One of the key components of velocity banking is the need for financial discipline. It's not a set-it-and-forget-it strategy. Requires active management of your loans and careful planning of your expenses. Not handled with care, you could end up in a worse financial position than when you started. Significant risk, specifically with using a home equity line of credit or HELOC, comes from leveraging your home equity. You fail to manage your finances properly, you could potentially lose your home. Your home is not just an asset, but a place of security and comfort. It at risk may not be worth the potential benefits for some. Potential for increased debt is another drawback. If you're not disciplined and continue to rack up debt on your credit card after using it to pay off your mortgage, you could end up with more debt than you initially had. This could lead to a vicious cycle of debt that can be difficult to get out of. Lastly, interest rates for lines of credit like a HELOC or PLOC can fluctuate. If rates increase, your payments will increase, potentially making it harder to pay off your debt. It's important to consider these risks and seek professional financial advice before diving into velocity banking. So, that's a quick overview of velocity banking, a powerful yet intricate debt elimination strategy. We've unpacked the intricacies of home equity lines of credit and PLOC, and how they're instrumental to this approach. We also addressed the critical aspect of maintaining a positive cash flow when implementing the velocity banking strategy. It's all about ensuring that exceeds your expenses. Without a positive cash flow, you might face difficulties in paying off your line of credit swiftly, which is pivotal to the success of the velocity banking strategy. We've also weighed the benefits, such as savings and accelerated debt clearance, against the potential risks, like possible hikes in interest rates. It's a unique alternative that could help streamline your financial future. Thanks for watching. Please give the video a like and subscribe to the channel if you found the information helpful.